to a lot of decisions that we end up making. And certainly that's apropos for this piece that we are going to talk about tonight, a little bit, I hope, and that is the analysis of conflict. So, what we're going to specifically look at is agency theory as a tool for analyzing conflict. We will look explicitly into how the fact that managers have an informational advantage over other players can result in managers taking actions that result in earnings management, right? How do they massage the numbers that they then share with users? Um, and then lenders will have a mistrust, right? They do have a mistrust of the accounting numbers, and it's unfortunately the case that sometimes managers exploit their informational advantage, and that can result in consequences for the lenders, the creditors, that go against their best interest. So, how do lenders then seek protection against those adverse effects? We will consider the implications of agency theory for accounting. And finally, we had talked about economic consequences last week. We will reconcile the efficient securities market theory with economic consequences. Starting with agency theory, agency theory happens to be a branch of game theory. We looked at the two-person um, game theory example last week, where Al and Bill were, the two people caught doing drug dealing, and they end up confessing, and they end up with a worse outcome, right? The Nash equilibrium. They willingly ended up with a worse outcome than had they cooperated, because to each one, since they lacked um, in trust the other person, they felt that the worse outcome of 3 years in jail um, was a better option than spending a much longer time in jail if the other party ratted them out. Um, Agency theory seeks to somehow improve upon that impasse, and so it looks at how contracts can be designed so that rather than we have a conflict of interest between the principal and the agent, and I've not just defined the terms yet. The principal happens to be the shareholders, for example, and the agent would be the man in a shareholder situation. Or for a lender situation, the agent is the bank, and the principal is still the management at the company. So how do we set up contracts so that we motivate managers to act in the best interests of the principal? And we can apply agency theory to look at employment contracts and lending contracts, where the manager is the agent in both cases, and the firm owners, the shareholders, are the eight principals for employment contracts. And in the case of lending contracts, you have the bondholders or the financial institution, the bankers essentially, as being the principal. Looking at agency theory and employment contract, where's the source of conflict? The source of conflict is essentially the moral hazard problem, that the owners of the business, the shareholders, don't have a way, unless the owner is there physically all the time at the company. The owners, the shareholders, have no way of telling whether the managers are really working hard um, to enhance the interests of the shareholder. For the shareholders, to think about it, the shareholder uh, wants the managers to work hard, because the thinking is if the managers work hard and do the right things, it will result in improvement in the performance of the business. But the shareholders can't be physically present to see what the managers are doing. And we have to keep in mind that the manager, being an individual, will want to maximize his or her own utility. And from the manager's point of view, they want to be paid as much as possible for doing as little as possible. The owners, the shareholders, want the managers to work as much as possible, as hard as possible, and to the extent that they can, the owners want to pay as little as possible. Because the less you pay to the managers, the more the shareholders get to keep of the profit. So when you have that inherent conflict, the manager wants to work less but get paid more, and the shareholders want the managers to work more but pay them as less as possible. Given that the managers are the ones in the driver's seat and the shareholders are not there to see what the managers are up to, the managers will likely do less work. They will shirk. So what you want to do is to somehow motivate the manager to work hard. And what typically is done to motivate the managers to work hard is that they are given a share of profits. So how do we come up with that solution? Let's look at it. So there's a series of steps that we could go through. From the point of view of the owners, they could start out with hiring the manager and then do nothing. You hire the manager and do nothing, the manager will likely, because if you hire the manager at a fixed salary, the manager will, after some time, figure out, hey, I'm just gonna get the salary and nothing else, so might as well stop working hard. What's the point? So if the owner just hires the manager and does nothing, very likely the manager, driven by their desire to maximize their own utility, is going to stop working hard. The owner could be there, physically present all the time. That's the best thing, according to the theorists, if it was possible for the owner to be like a hands-on owner. And that is true for private companies. If you're a hands-on owner, then if you're the time that you're there, the owner is there, the employees, they definitely try to work as hard as they can, because otherwise the owner will notice that they're not doing their work and they could get yelled at or fired. But that means as an owner, you don't have a life. You got to be there at the business all the time. Maybe works for a small business, but you cannot scale your business. You cannot ramp up because if you have multiple, let's say, even if the owner has multiple locations of their business, they can't be there physically present at all the multiple locations at all the time. So this first best option is not the best when it comes to the quality of life for the owners. A third possibility could be to apply moving support, where the owner basically says, I expect a certain baseline earnings, and if the business does not earn it, Mr. Manager, you'll have to reimburse me. So that's almost like a imposing a rent. And that's basically number 4. Number 3 and number 4 are kind of linked together. You impose a minimum requirement, minimum earnings requirement, and the manager is responsible to earn that, right? So the manager has to pay out of pocket if the business does not earn enough income. Now, I wonder how many people would want to be a manager in such a circumstance. I mean, that's highly risky. All the risk falls on the manager. It would be very unappealing to an employee, right? If they can't get to keep any part of the profits themselves, and on top of that, they are forced with the risk to make up any losses to the owner for lower earnings, that wouldn't generate a lot of applicants to that position. Number four is kind of like that. You have the owner renting the firm to the manager. This one, maybe, if the manager is fairly certain that, they will be able to. Uh, so this is kind of like what happens for taxis, right? So there are people that own the taxi license plate, and they rent that license plate to drivers at a fixed weekly rental. So to give you a sense, let's say the fixed weekly rental is $200. Now, the person that's renting that license plate, they know that if they drive the cab, right, maybe they can earn $1,000. They will pay $200 rent to the owner of the license plate, and they will keep the rest. So it ends up being a fixed rental. From the owner's point of view, there is no possibility of getting more money, right? You're limited to a fixed amount. So from the owner's point of view, not the best outcome, likely. Indirect monitoring, it was not the best outcome for the manager here. Maybe the manager gets to keep all of the residual profits over and above the payment of the fixed rental. So after having tried out everything, right, the last setup is that you get the manager to work on your side, to work on your behalf, but promise them that, hey, Mr. Manager, if you work hard and the company's financial performance is strong, and if the company makes a profit, we will give you a portion of the profit. And that's the bonus, right? So you want to pick up a performance measure to decide whether the manager should receive the bonus. And that performance measure should be informative, should tell us whether the manager indeed worked hard or not. And we'll be looking at this in more detail in subsequent topics. So I'm not going to expand on that too much. But the idea is you want to give the manager a share of the profit, and that's your bonus. A little bit deeper into the concept of fixed versus moving support. So a fixed support, you're looking at a situation where um, the outcome is more or less unchanged, regardless of whether the manager works hard or not. So if you have a scenario where a company's net income doesn't really change much, no matter if the manager works hard or does not do much work, you're essentially talking about a company that is well set, that's got a fixed market share, that's relatively looking at a fixed contribution margin of earnings. So more or less a dominant player, and they are, regardless of whether the managers do work hard or not. You can think of government businesses where no one cares, the amount of the profit or the financial performance is indifferent to whether the people, the employees or the managers work hard or don't. The business kind of works on autopilot. So in that case, paying bonuses or not really would not help much. You need a scenario where there's moving support. A moving support scenario happens when you can tell by looking at the performance indicator. For example, if it's net income, you can tell by looking at the net income number if the managers had been working hard or not. You want to be an industry where the company's revenues and profits essentially are dependent on whether the managers took actions so whatever actions that managers take, there should be a possibility of those actions translating into higher profits for hard work and lower profits if managers don't do their work properly, don't put in the effort, or they start neglecting their duties, then that should have a result in terms of lower net income. If, assuming net income was our performance measure, you could argue we can go with stock price. If the company's stock price would reflect a scenario where managers have not been doing the work that they're supposed to, especially the top management team, the CEO, CFO, and all. If those people lack the vision, if they lack the ability to implement strategy, in a forceful manner, well, then if the company's stock price starts, falling as a result, then we would say that we have moving support. In this case, it is possible for the manager to be penalized because they will only get the salary, right? The manager is guaranteed a salary, but the manager will not receive any bonuses, right? The bonuses will only kick in if the performance is it meets or beats certain threshold, right? The target. So you impose targets for either the net income or a stock price, and the managers will receive additional compensation. Think about stock options, for example. The stock options specify a minimum threshold price before the options are in the money. And so, if that threshold price is reasonably set, current stock price is $10, and you can say the uh, the strike price for the options is $20. Well, assuming that the $20 number is not outrageously high, and if it is possible for the managers to influence that stock price by working hard, then the manager will definitely be motivated to work hard because it will be in his or her better interest to work hard so that these companies' stock price goes up above the $20 threshold, because then they can benefit from the value of those stock options. So that's the general idea here, that you want to align the interests of the managers to those of your shareholders. Further terminology: first best versus second best contracts. If you have a first best contract, will give the owner the maximum amount of utility, but ends up giving the agent their reservation utility. I don't want you to stress out about these terms. We will look at examples, numerical examples about these terms. So reservation utility is sort of the minimum amount that a manager is willing to accept, right? So consider that the theoretical profit for a company is $100,000 after subtracting all other costs but the manager's compensation. Now, let's say this manager is willing to work for a minimum of $30,000. Under a first best contract, the manager will only get $30,000 because that's the bare minimum that this manager is willing to work. And the remaining 70,000 is profit for the shareholder. Now, obviously, you can tell that for the manager, they're just, he or she is just getting the bare minimum that they were willing to work for. So they don't get anything in addition. All of the cream remaining profit goes to the owners. Now, that is in theory possible, but in reality, it may be hard because the owners can't be around. And when managers, are running the company and the owners are not around, they can always lie about their effort. So what ends up happening is that there are agency costs that get imposed, and that's the amount by which the principal's utility is reduced if you cannot get this first best outcome, right? So if we cannot achieve this scenario where the owner could get away with paying the manager just the bare minimum that the manager is willing to accept. Well, if the manager starts lying about their effort, because the owner's not there, the owner can't really do much. The company's profitability can suffer. The manager could be, the manager could show up to work and not do any work. What happens is the manager says, if all you're going to pay me is my basic salary, for example, I'm going to stop giving I'm going to stop caring. And that's not good, right? That's not a good outcome from the owner's point of view. So what ends up happening is that we arrive at the second best contract, which is the more efficient outcome possible if the first best contract is not feasible. So in an ideal world for the owners, the first best contract would be would be the most preferred. Any business owner wants to keep the maximum amount of profit for themselves. And that's one way that is possible is by paying the workers as little as possible as they can get away with. They still need people to work, but they want to pay as little as possible. Maybe some of you have experience of that or have seen that in reality. But when you have such circumstances, either people stop working hard or they are always on the lookout for the next opportunity. They're always on LinkedIn or something like that. So the second best contract is what agency theory gives us. And it says, listen, you need to motivate this person, right? And one way that people get motivated is through the promise of extra pay if they put in the effort. And if there's a link between the effort that the employee puts in and the resulting income, then we can by sharing a portion of the profit with the employees will result in an improvement over what you would get if the employee is not offered any variable compensation. Now, why is that the case? The profitability, the payoff for the business, the net income, for example, is not observable until the year is ended, right? So if you hire a person for a year, your net income for the year will not be known for sure until the year is done. And if you hired the person, you got to pay them their salary, right? So if we are going to offer people bonuses or some kind of variable compensation, we need to be able to set a target for the employee to be eligible for the bonus. And so that could be the net income, for example. So we need a performance measure that will help predict the outcome for the business. So the payoff over here is the profit, let's say. So we need a performance measure that will predict the payoff. Now, unless the business owner is around all the time, whether the managers were working hard or they were hardly working, we can't directly observe it, or we cannot either directly infer it. Then we want to be able to devise a contract that will give the manager, over and above their salary, a share of the net income, if you go with the net income as a performance measure, so that they are willing to work for the company. Number one, that you're paying them enough so that they will work for the company. And also that when they're working for the company, that they will be incentivized to work hard. Now that requires a performance measure that is unbiased, that is precise, and is sensitive. It's sensitive to effort. So we will be looking at these concepts, sensitivity and precision, when we look at possible performance measures that businesses should be using. I mentioned reservation utility. The reservation utility is the minimum amount of utility that a manager will accept before they choose to go elsewhere. So essentially, that's the bare minimum the manager needs. That's their market value in a sense, right? So, for example, if a company is looking to hire someone for a junior accountant's position. Now, there are a few candidates that come for the interview, and all of the candidates have done their homework by looking up, the internet, Google, and they have looked up the Robert Half salary survey. And the Robert Half salary survey is notorious because it, at least in my experience, it overstates the salaries for position. So say the Robert Half survey tells that a junior accountant should be making anywhere between $60,000 to $65,000 a year. Now the company is essentially looking, for a person in the range of 50 to 55,000. If I went there as a candidate and in the back of my mind, I've seen the Robert Half survey and I know that the range is 60,000 to 65,000, and I feel I'm a really strong candidate. In my eyes, my market value is 65,000 because I feel that I'm the best applicant for the position and I should be paid at the higher end of the range. The business that is looking to hire me, on the other hand, in their mind, their range is 50 to 55,000, and they would sooner want to hire at the lower end of the range, 50,000, than even the higher range. So typically businesses will ask this question, right? The HR person or whoever's interviewing will ask this question: what's your salary expectation? So if I answer, oh, I want 65,000, I'm likely not even making it to the second round, right? Now, maybe I played smart and I said, oh, that part is negotiable. I would like to make sure that we are a good fit and so on. So I am a really good talker, etc. And let's say I make it to the next round and the next round, and now I get an offer. So I get an offer from the business, $50,000 or something. I can, of course, refuse, or I can bargain. The business will likely go to the extent of 55, maybe 56,000 if they're really desperate, but they won't really pay me more than that because in their mind, that is how much that particular position is worth. Now, unless I've got a ton of other options, right? If I'm in the job market and I don't have other options, I might accept that offer at the 55, 56,000 range, but I'm not going to be a happy camper in that position. I'm taking it temporarily, but I'm still in the market. I still keep looking, and that's what seems to be happening right now in the job market, from what I'm seeing. That people are mistakenly sort of expecting that companies should be paying higher. There is, of course, this talk about inflation, et cetera, et cetera. Cost of living has gone up. But at the same point in time, if that results in higher wage costs for the businesses, they are going to pass on those higher costs as higher prices. And this inflation, genie cannot be put back in the bottle. So somewhere something's got to give, somewhere's got to move. And this is a very, very, very delicate balancing task. So from the employee's point of view, they will not accept a job position generally unless they feel that they're receiving at least what they are worth. Now, what they are worth from the employee's point of view will be at the higher end of the range for them, And for the business wants to hire a person at the lower end of the range that the business feels that job position is worth. So that is where you have this conflict. And the role of agency theory is to somehow, now, if this business can potentially do so, what they could make me interested in is say, hey, Harjinder, we're offering you a salary of $55,000, but you know what? You can potentially make bonuses of ten to $15,000, and that depends on the company's profits. So now it's possible for me to make as much as $70,000 if I add the bonus. What I have to, as Harjinder has to now see, is whether it is practical, whether he can get that additional bonus. So what does Harjinder need to do? If it's based on net income, if the role that Harjinder is working in, if by working hard at that role, Harjinder can contribute to the profitability, then Harjinder will likely accept that job offer and work hard. But if Harjinder feels that no matter how much of effort he puts in, he's not going to be able to earn that bonus. So even if that offer of the bonus is there on the table, it's really not, it does not impact the calculations that Harjinder or the employee makes for that particular position. So that's number one, the reservation utility. It's the minimum amount of utility that the manager or the employee in general needs to receive. The second piece is disutility. Now, disutility is it's an interesting piece. So once you accept a job role, right? Once you accept a job, accepting a job is one thing, right? Like everybody wants a paycheck. But in order to get that paycheck, you have to work. And that can, if you think about human beings, in general, a lot of people are naturally lazy, right? If I could get paid, right? I'm a professor, so my work role is to go teach classes, do a little bit of research scholarship work, attend meetings, etc. And personally, I would love to get paid and not have to work much, right? So I would, if I have to teach 8 courses in a year, I would sooner teach 8 sections of the same course, right? Rather than have different sections of different courses. Because if I taught 8 sections of the same course, I'll have less work to put in. Like it'll be less effort on my part. I'll just be repeating the same prep. I would sooner not have to go and attend meetings. It'll be nice, really nice if I could just sign into a Zoom meeting or a Google Meet and turn off the camera. I'm not talking, so I might be doing other things and I'm there in the meeting, right? So you may have seen some people kind of do that, or I'm there in my office and I'm playing solitaire or I'm watching YouTube videos, etc. Not really doing any productive work, right? And there are some people who just hate waking up in the morning, right? Or do I have to go to work? Oh, look, it's snowing outside. Can I not stay back? Um, as an aside, I heard back from a couple of old students of mine during COVID. They were working for the CRA. Oh, one person told me about the other guy. He said, this guy wakes up in the morning, and apparently, if you put a paper clip on the shift key on your keyboard, you know how you have these Teams apps, and the Teams app will show you as a way if there's no activity on your keyboard, right? That's how sometimes companies keep track whether someone's online, they're actually doing work or not. So he just figured out that all you got to do is put a paper clip on the shift button, apparently, and your Microsoft Teams will show you as online all the time. And then he said he just wakes up in the morning at 8 o'clock, logs in, puts on the shift button, goes back to his bed and sleeps till 10:30. Doesn't do anything, and no one can tell, right? Because if you're working as a CRA agent, let's say, you're given some files and you can say, oh yeah, I'm working on the files. No one's really following up on performance. You can get by, you get paid, and you're not really working hard. So these are important considerations, right? And in agency theory, we somehow stylize them and we kind of try figure out a way to quantify this decision to see how um, we can amend the employment contracts to try to induce people to work hard. I'm not advocating that CRA agents should receive hefty bonuses, but if maybe a certain amount of variable pay could be introduced, people's life would be happy and they would merrily do the extra work. So on that note, I'm gonna stop this class. What I would like to do next class is do a numerical example of what we talked about, this reservation utility, disutility, etc., how that plays out. And then we will, all right, let's get going. So yes, Arnold is the owner here. So Arnold would be from our vantage point, Arnold would be the principal because they own the business. And Minnie is the potential agent, right? So Minnie would be working in the employment of Arnold while Arnold is away. So before we read more about this particular case, we have to make certain assumptions about these people as individuals. Both would be, I would say, risk averse, but utility maximizers, because both are individuals. Individuals are typically risk averse, but they tend to prefer to maximize their utility. For Arnold, his utility is maximized if net income of the business is maximized, right? So Arnold wants the business to be as profitable as it can be. Minnie, I would argue, her utility would be maximized if she receives more pay, right? Even though she will likely have a concave utility curve, she will experience greater utility the more she's paid. Now, because Minnie is an agent, Minnie also has this notion of reservation utility. That's the way I see it. Reservation utility is the minimum amount of utility that Minnie must receive for her to accept employment. And if you think about it from Arnold's point of view, if Arnold is trying to maximize the net income of the business, the reservation utility would also be the maximum amount, theoretically, that Arnold would like to pay to Minnie. Now, there is the sense of disutility from effort. And this is the fact that any person, the sacrifices or discomfort one must make or experience from exerting any kind of effort. And so the sad assumption here is that one does not want to work because one enjoys work. One has to work because one has to live a life, right? One has to earn a living. Otherwise, most of us would prefer to have lead the lives of poets like Wordsworth and all. Like we would want to look at fields of daffodils and marvel at the beauty of nature, etc. You know, if we could afford to not have to work, like if we could afford to stay at home and watch Netflix all the time, that would be an ideal world for us. So the fact that we have to show up to work and actually perform work is is to a degree not palatable, not enjoyable. So we experience a sense of um, discomfort from having to put in the work. So from an agent's point of view, there is this concept of net utility, right? So net utility is essentially for an agent, it is the utility from the pay they receive the employer less any disutility from effort. So when you're comparing reservation utility, it is this net utility that you want to compare the reservation utility to, right? So agent will compare his or her net utility to the reservation utility when deciding whether they want to accept the employment or not. They want to compare, they want to first determine what the net utility is going to be, and then compare that to to their own reservation utility. And it's the concept of reservation utility is entirely subjective, right? So it varies from person to person, right? The sense of how much I am worth, well, that is a very subjective thing. Yeah. So keeping these things in mind, let's now go back to the case facts and read the next paragraph. On the basis of extensive past experience, Arnold knows, remember Arnold is the principal, knows that if the manager works hard, the cash flow, which is the payoff, from the year's operations will be $505. You can add zeros to your taste. So these numbers are unrealistically small, but they're just intended to demonstrate a concept. The cash flow from the year's operations will be $505 with probability 80% and $345 with probability 20%. If the manager shirks, cash flow will be $505 with probability 20% and $345 with probability 80%. These payoffs are before any manager compensation. So we have to take out manager compensation from these expected payoffs. However, cash flow will not be known until sometime after Arnold returns. And Arnold's going to be away for a year. Since all sales are on long-term credit and advertising costs incurred in the year continue to generate sales well after year end. However, many demands to be paid at year end. I can see that my video has gone a little berserk, so I'm gonna close my video just to save on some bandwidth there. So many needs to be paid. Arnold would not know what the cash flows actually is going to be until Arnold returns from his 1 year sojourn. Arnold decides to base compensation on net income. a performance measure available at year end. Due to random effects of states of nature, he knows that if the payoff is going to be $505, net income will be $625 with probability 70%, and $225 with probability 30%. If the payoff is going to be $345, net income will be $625 with probability 30%, and $225 with probability 70%. Net income is before any manager compensation. Upon interviewing Minnie, Arnold finds that her reservation utility is 2.6, that her utility for money equals the square root of the amount of money received, and that her disutility of effort, if she works hard, is 8. If she shirks, her effort disutility is 7. Arnold decides to offer Minnie a 1-year contract with compensation based on a percentage of audited net income before compensation. Minnie accepts. So the question here is asking, what percentage of net income before compensation did Arnold offer Minnie? Verify that Minnie will work hard. You know what? This is a much harder question than I intended. I'm going to do a simpler question first before we launch into this one. This will be a little too hard to take a look at from the get-go. So instead, let me add another sheet to give you a simpler example of an employment contract. And this is looking for the Pierre example. Where is Pierre? All right, here, number 9. Here's the example. Again, Pierre is the business owner and Yvonne is the manager that Pierre is interviewing. You folks with me on this? The scenarios will all be very similar. So over here, what do we have? Pierre's small business has grown to a point when he plans to hire a full-time manager. Pierre is an architect. He has little inclination and ability to manage a medium-sized, fast-growing business himself. He plans to semi-retire, devoting his working hours to consulting on issues of design and project management. His accounting system is quite simple. There's no research and development or other lags. Consequently, the firm's payoff and its net income are equal for the year. Pierre is negotiating with Yvonne as possible manager. So Pierre is considering Yvonne as a manager, and he wants the manager to work hard. Since his past experience is that hard work generates a net income of $2,000 90% of the time, and $900 10% of the time. In his recent experience, when Pierre himself has not worked hard, the $2,000 net income is generated only 10% of the time. Otherwise, net income is 900. So consider this, you work hard, the net income for the business is higher, right? Work hard, the $2,000, the probability of net income is 2,000 is 90%. You don't work hard, like shirk, the probability that the net income will be high is only 10%. And the probabilities are reversed. For the lower net income. The other possibility is that net income can be on the lower side, is just $900. So if you work hard, 90% of the time net income is 2,000. 10% of the time net income will be 900. Whereas in terms of shirking, there is a 90% probability that net income will be on the lower end. So Pierre obviously wants Yvonne, or the manager here, to work hard because he wants to benefit from the higher income, right? That's what Pierre wants for his business. While he's away, he does not want to give up on the possibility of higher net income, because Pierre benefits from the higher net income. The higher the business earns, the better it is for Pierre. So Pierre wants Yvonne to work hard, right? That's what Pierre's interest is. Now, if you consider Yvonne the potential agent or the employee, human beings, I would say, right? Pierre has ascertained that Yvonne is both risk averse and effort averse. Risk averse, we understand. Effort averse is just I would say, a fancy way of saying she's lazy, doesn't want to work hard. I would say doesn't want to work hard for nothing, right? She needs motivation. She needs incentive to work hard, right? Yeah. One meaning of effort averse would mean does not want to put in the effort, so is lazy. But I would say basically needs incentives, right? Needs an incentive to work hard. Her utility for money, so Yvonne's utility for money, is equal to the square root of the amount of money received. Her disutility for effort is 40% if she works hard, 1.1 if she shirks. Her reservation utility is 11. Pierre decides that Yvonne is ideal for the job. He quickly offers her a series of one-year contracts with annual cash compensation of $100 salary plus 10% of net income before manager's compensation. Yvonne immediately accepts. So first part of our calculation is to demonstrate why Yvonne accepts the position. And then which act do we predict Yvonne will take? Will she work hard or will she shirk, i.e. not work hard? So what do we expect to happen in this case? So when you're faced with a question like this, we want to calculate Yvonne's expected utility, right? We want to calculate Yvonne's expected utility. So part one, part A, we want to calculate Yvonne's expected utility. Now there's two actions that Yvonne can take. She could work hard. If Yvonne works hard, net income may be $2,000 or it may be $900. The probability that net income will be 2,000 if Yvonne works hard, the probability of net income being 2,000 is 90%. Right, 0.9. And the probability is 10% that net income will only be $900. Now, what is Yvonne's compensation? how much money does Yvonne get as a result of the net income numbers? Remember, we are told that Yvonne is going to get $100 salary plus 10% of net income before manager compensation. So $100 of salary plus 10% of net income, right? Net income is 2,000 in this case. So 10% of $2,000 will be the commission, right? So total compensation will be $3,000. On the other hand, if net income is $900, then Yvonne will still get a $100 salary plus 10% of the net income, which is $90 on top. So Yvonne will get $190. Now, how is Yvonne's utility calculated? Her utility is equal to the square root of the money she receives, right? So utility is equal to square root of the compensation. So if I calculate square root of SQRT of 300, I get, and we are asked to take the calculation to 2 places of decimal. So increase decimal spaces, I get 17.32. If Yvonne gets $300 compensation, her utility will be 17.32. If on the other hand, Yvonne's compensation is 190, her utility will be square root of 190, which is 13.78. Now keep in mind, there are probabilities involved here. Net income will be 2,000 with a probability of 90%. So we need to figure out expected utility. So this is hopefully a reminder of an earlier chapter when we worked on the individual decision maker. So there is a 90% probability that Yvonne will receive a $300 compensation. So there's a 90% probability that Yvonne's utility will be 17.32. Right, so that works out to 15.59. And a 10% probability that her utility will be 13.78, right? So 10% times 13.78 gives us this. If I add these two amounts together, I get 16.97. So this is Yvonne's expected utility from working hard. But we need to determine Yvonne's net utility. Expected utility is not it, because if Yvonne is working hard, she experiences disutility of 4 units, right? Her disutility for effort is 4 if she works hard. So we need to subtract disutility, right? The sacrifices that Yvonne has to make in terms of her quality of life because she has to go work and so on. So her net utility from taking on, oops, since I'm subtracting, I need to add there. Her net utility is 12.97. If you compare 12.97 to Yvonne's reservation utility, Yvonne's reservation utility is 11. So is 12.97 more than 11? The answer is yes. So we expect Yvonne to have said yes on this count, right? She works hard, she will get a net utility of 12.97. Since Yvonne's reservation utility is 11, she would accept. But what about if Yvonne does not work hard? What would the numbers look like in that case? Right, so I'm just copying and pasting this stuff down here. If Yvonne does not work hard, i.e. if she shirks, in that case, the probabilities are changed, right? The probability that the net income will be $2,000 is only 10%, and the probability that net income will be 900 is now raised to 90%. Yvonne's compensation will stay the same, right? If net income becomes 2,000, Yvonne will get her $100 salary plus a 10% commission, so that's $300. Her utility will be the square root of 300, which is 17.32. But expected utility will be the probability weighted utility number. So 10% chance that utility will be 17.32. So 10% times 17.32 gives us the 1.73. And there's a 90% likelihood that her utility will be 13.78. So 0.9 times 13.78, we get 12.41. So when I add these two together, I get expected utility 14.14. Now, what about the disutility? If Yvonne does not work hard, she will not have to sacrifice too much of the good life. So her disutility, if she shirks, is 1.1. All right. So we need to subtract her disutility. And in this case, that is 1.1. Now, notice that the net utility that Yvonne gets from shirking is 13.04. So Yvonne accepted the job offer since her expected net utility will be greater than her reservation utility of 11, right? So in both cases, her reservation utility is being exceeded. But after accepting this job offer, what do we expect Yvonne to do? Because remember, she's a utility maximizer herself. Which of the two actions gives Yvonne the higher net utility? Will Yvonne be happier from working hard? The second one, right? She's got greater. And so I know that this does seem to give us a rather dismal sense of how people work or how people think. But that's financial accounting theory for you, yeah? So financial accounting theorists over here will indicate, well, if Yvonne is likely getting overpaid, and in both cases, her reservation utility is exceeded. So if Yvonne will be very happy to accept the job offer. And since she receives more utility from doing less work, from not putting in hard. Gera's asking, did I send the class notes on D2L? Gera, this is an example from last class, right? So this is still related to last class. If you're talking about chapters 10 and 11, not yet. I have not posted them yet. This is an example from last class. The link to the file, in case you want, is right here. Okay. So just working on last class's material. So like you said, Yvonne accepted the job offer. She is expected to shirk and not work hard, since shirking will result in a higher net utility for her. Okay, so that's our answer to part A. After 2 years, so this is part B, Pierre is worried because net income has been $900 each year. Oh my God, I wonder why, right? Why do we think that happened? Well, quite likely that Yvonne has not been working hard, right? And since shirking is more heavily correlated. There could be the odd year when the income could still be $2,000, even if Yvonne did not work hard. But the greater likelihood is that it won't, right? The net income will be not as high because, of course, the person running the business is not putting in the effort. So Pierre decides to change Yvonne's next year's compensation contract. After consulting a compensation specialist, Pierre offers her a salary of $52.30. Compare that to a $100 salary, $52.30, plus a 9.21% share of net income. So instead of 10%, a 9.21% of net income before manager compensation. Yvonne hesitates, but decides to accept. Show calculations to demonstrate why she hesitates but accepts. Now, before we launch into the calculations for part B, consider the fact that initially Pierre has, in all good faith, offered Yvonne a fairly good package, right? Pierre knows that he's not going to be around, he's going to be away, and he wants, all the best for Yvonne, and he knows that, she's risk averse. She's also maybe a effort averse. So he's heard of the fact that if you give managers a share of the income, they will likely work hard, right? So he's heard of the theory. So he's offered Yvonne a fairly good salary and a 10% share of net income. So in principle, Pierre has done all the things that theory will predict. Like, you give them your employees a good salary, you give them a share of net income, and they will then act hard, to they'll make sure that they're working hard to ensure the business's success. What this question sadly is demonstrating is that sometimes we might end up paying too much. Okay. And if a person feels that they're already getting too much without having to work hard, they may resort to sort of enjoying the good life rather than putting in the effort. Right? Even though Yvonne was getting a 10% bonus and $100 salary, right? You can always add as many zeros to make it lucrative. It could very easily be $100,000 salary and 10% share of profit and all that. On paper, it seems like Yvonne was getting it good. Now, what's being offered is her salary has been slashed to almost half, $52.30, and her share of profit is also being dropped from 10% to 9.21. Where did they get these numbers from? It's beyond the scope for this question, but assuming that this was the case, Yvonne still accepted. So that's the curious part. But there was hesitation. In the first case, Yvonne immediately accepted. There was no hesitation, right? Why was there no hesitation? Well, because we could clearly see that the amount of pay being offered was much higher, much above Yvonne's reservation utility. Reservation utility is the basic minimum that a person needs before they will accept. So her reservation utility was being more than met by the job offer, and so she had no hesitation. In part B, we will be able to see why Yvonne hesitated. All right, so under the new contract, $52.30 salary plus 9.21% bonus. If Yvonne works hard, what will her compensation be? She will get salary of $52.30, and the commission that she gets or the bonus that she'll get will be 9.21%. So 0921. So her pay, if net income is 2,000, Yvonne's pay will be $52.30, the salary, plus 9.21% of the net income. And if net income is $900, Yvonne will get $52.30 plus 9.21% off the 900. Now, since the formulas are already laid out, the utility will be square root of 237, that's 15.38, and square root of 135, that's 11.63. Probability, 90% and 10. And you get net utility 11. Remember, we have seen 11. 11 happens to be Yvonne's reservation utility, right? So from working hard, Yvonne will be able to achieve her reservation utility just enough. If Yvonne shirks, her compensation, her net utility, in this case, will end up being 10.9. So can you see why she hesitated? As compared to part A, where under both circumstances, the net utility was more than 11. In this case, she will be able to achieve 11, the reservation utility, only in one case. So Yvonne hesitates since she expects to achieve her reservation utility only in one case, that is from working hard. But that's not quite it. Remember that Yvonne works hard, there's a high probability, right? 90% probability that net income will be high. But there's always a slim probability that the net income might still end up being low, even if Yvonne works hard, right? So it does impose the fact that net income may still be low in spite of working hard, imposes additional risk on Yvonne. Right? So that's the hesitation part. But the fact that she's accepted means that she's going to now work. But what do we expect her to do? Do we expect her to work hard or shirk under the circumstances? Work hard, yeah? We expect Yvonne to work hard. Having accepted the offer, we expect Yvonne to work hard or look for another job in the meanwhile, right? I mean, that can happen too. You know, she hesitated, bit her lip, okay, but she might float her resume, start floating her resume very quickly. All right, any questions so far? Is this, and the calculations are whatever they are, but conceptually, does this make sense? All right. Part C. Yeah, so her reservation utility is 11, right? So that's given here. So she is able to make her reservation utility. Remember, reservation utility is the minimum amount of utility that Yvonne has to get before she will even consider working. If the new compensation contract gave her less than her reservation utility, she will likely decline. She will likely turn down the offer. All right, part C. Pierre is risk neutral with utility equal to the amount of profit received after manager's compensation. Is Pierre's expected utility higher or lower under the new contract in part B compared to the original contract in part A? Show calculations and explain why there is a difference. All right, part B. Pierre's expected utility. Based on the original contract, Yvonne is expected to shirk. Right? Keeping that in mind, if Yvonne shirks, net income, okay, and sorry, Yvonne's compensation from the original contract. $300 if net income was 2,000 and 190 if the net income was $900. So Pierre's net income or Pierre's share of income, if you want. If we are paying $300 compensation to Yvonne, then Pierre gets to keep $1,700 out of a net income of 2,000 before manager compensation. If we pay $300 to Yvonne, Pierre gets to keep 1,700. And if net income is $900 and we pay Yvonne 190, then Pierre gets to keep 710. But these are both numbers that depend on probabilities. So Pierre's expected utility in Pierre's case, there is no square root, etc., because Pierre is risk neutral, we are told. So his expected utility is the share of income times the probability. So there's only a 10% chance that Pierre will clear $1,700, but a 90% chance that Pierre will only make 710. So probability adjusted, Pierre's expected utility was $809 based on the original contract. Now, based on the new contract, Yvonne is expected to work hard. So Yvonne is expected to work hard. There's a 90% probability that net income will be 2,000 and a 10% probability that net income will be $900. Yvonne's compensation has now changed, right? So Yvonne gets $52 in change for salary and 9.2% for the share of profit. So that means Pierre gets to clear out the net income minus Yvonne's compensation. So 1,764 and $765 respectively. And it doesn't take us rocket science to figure out that Pierre's expected utility is much higher under the new setup than it was before. Pierre expects to keep over $1,600 of profit because Yvonne is going to be working really hard. So is Pierre better off? You betcha. This question works. All right. If we are good with this, let's take a look at a lending scenario. This is relatively simple as well. So we have a risk neutral investor. Mr. K is a risk neutral investor. And he's thinking about a 1-year 8% loan of $500 to a company called J. Mr. K demands at least a 6% expected return per annum on loans like this. K is concerned that the firm may not be able to pay the interest and or principal at the end of the year. A further concern is that if he makes the loan, firm J may engage in additional borrowing. If so, K's security will be diluted and the firm will become more risky. The company keeps borrowing, the collateral available to the lenders is, they are now a part of a bigger group of people who have lent money to the business. So that is the dilution that he's worried about, Mr. K is worried about. Since J is a growing firm, right, it's growing rapidly, K is sure that the firm would engage in additional borrowing if he makes the loan. So that is a very valid concern. Company K is very likely going to borrow more money from other parties. K examines firm J's most recent annual report and calculates an interest coverage ratio. Interest coverage ratio is, for those of us that have taken other courses in financial accounting as well as maybe in finance, it's basically equal to earnings before interest and taxes divided by the interest expense. Earnings before interest and taxes. Sometimes people inadvertently think it's earnings before income taxes because IT, it kind of sounds like, oh yeah, that must be income taxes. No, it's interest and taxes. Okay. So you want to basically see how much of income this company is making before subtracting interest expense and the income tax expense, and what multiple of the interest expense is that number. So you want this to be as high as possible. From a lender's point of view, right? Because they feel more secured if the interest coverage ratio is high. So K has calculated an interest coverage ratio of 4 after taking into account the intended $500 loan. Upon considering all of these matters, K assesses the following probabilities. So K thinks there are three possible outcomes from making this loan. The first outcome is K will get his interest along with the principal, and he believes there's an 80% probability of that happening. A second probability is that the company will reorganize, will pay off the principal, but won't pay any interest. There's an 18% probability. And the third one is the company will go bankrupt and K will get nothing. There's a 2% probability of that happening. So to answer part A, if Mr. K should make the loan, we need to figure out his expected utility, right? So we have three scenarios, and I'm just going to name it 1, 2, and 3. The payoff in scenario 1 is Mr. K will get his principal of $500 plus an interest of 8%. It's an 8% loan, right? So $500 plus an interest of 8% on the 500. So that's a total of $540. The probability of that happening based on Mr. K's analysis is 80%. The second scenario is the firm reorganizes, will pay off the principal, but no interest, right? So in that case, Mr. K will only get $500 back, and he believes there's an 18% chance. And then there's a 2% chance that he'll get nothing. So if we now calculate a probability adjusted value, right? So his expected payoff, Mr. K's expected payoff is each scenario's payoff adjusted for the probability. So 80% chance that the payoff will be 540, 18% chance that it will be 500, and then 2% chance it will be 0. If we add up, we get 522. Now, what's the minimum required payoff? Mr. K wants at least a 6% expected return per annum. So his minimum required payoff is the $500 loan plus a 6% interest on the loan. You calculate that 500 times 1.06, the minimum payoff is 530. Is the expected payoff on the loan equal to or greater than 530? The answer obviously is no. So the answer to part A is based on the expected payoff as the expected payoff from making the loan to J is less than Mr. K's minimum required payoff, he will not make the loan, or he should not make the loan, right? Because he is not getting the minimum amount of payoff that he requires. Does this make sense? Yep, easy enough, I hope. Okay. Firm J offers to add a covenant. A covenant is a stipulation, a requirement to its lending agreement with Mr. K. undertaking to not to engage in any additional borrowing if its interest coverage ratio falls below 4 before the next year end. The firm J says, hey, we understand that you're concerned about, us taking on more loans. We will not borrow any more money if our times interest coverage ratio goes down below 4. Mr. K estimates that there is a 60% probability that the interest coverage ratio will fall below 4. If it does, the company will not borrow any more money as per the loan covenant. If it does, there will be no dilution of his equity. And he feels the lower coverage ratio will still be adequate. He assesses that his payoff probabilities would then be this 95% probability of the first payoff, 4% of the second one, 1% of the third. If the coverage ratio does not fall below 4, the resulting additional borrowing and dilution of security will cause him to assess his payoff probabilities at 87% probability for the first payoff, 12% for the second, and 1% of the third. Now, considering this, should Mr. K make the loan? Well, essentially, we have to do a similar calculation as above, except that now we have the calculations in two parts, right? There's two scenarios in play. We have the payoff being 540, 500, and 0, right? If interest coverage ratio falls below 60, below 4, the probability is, if the interest coverage ratio falls below 4, then the company will not borrow any more money, right? So the probabilities of the payoff will be 95%, 4%, and 1%. And if interest coverage ratio does not fall below 4, is above 4, then these payoff probabilities are 0.87, 0.12, and 0.01. Okay. So what we need to do is calculate what will be our expected payoff for Mr. K under these two scenarios, keeping in mind that there is an overall 60% probability that interest coverage will fall below 4, and therefore a 40% probability that it will not. So to do this math, probably easier if we calculate what the outcome will be here. So if you calculate the expected payoff, in this case, there's a 95% probability of $540, 4% probability of $500, and so on. So that works out to a total of 533. And the expected payoff for this second case is 540 times 87%, 12%, and 1%. And if I add them together, it's 529.8. Now, the overall probability that interest coverage ratio will fall below 4 in Mr. K's estimation is 60%. So overall probability, overall expected payoff is 60% chance of 533 and 40% chance of it being 529. If you multiply 533 with the 60% chance that interest coverage ratio will fall below 4, we get 319.8. To that, you're going to add the 40% chance that the expected payoff will be 529.8, that is 211. If I add the two together, I get overall expected payoff is 319.8 plus the 211.92, I get 531.72. The minimum required payoff, remember, is 530. So under the circumstances, what would you say Mr. K would do now? Will he make the loan or will he not?
I'll take the loan.
Will he? So now, as Mr. K's expected payoff is greater than his minimum required payoff, he should make the loan. So what was the clincher here? What caused Mr. J to or K to change his mind? It was the fact that the company was fine with signing a covenant, right? Agreeing to a covenant. So debt covenants are, for most companies, when we're talking about a lending situation, the lenders, they seek protection and they add these covenants. So they add some stipulations. So covenants are stipulations attached to a lending contract or a bond which imposes requirements and limitations upon the borrower to maintain certain financial ratios which are designed to protect the security of collateral for the lender. Usual examples you will find will include a minimum times interest coverage ratios, a minimum current ratio, and maximum debt to equity ratios kind of thing. Right? So you impose ceilings for certain numbers and thresholds or floors for certain other numbers, right? And there's usually a combination. The consequences of a breach, if a borrower breaches a debt covenant, there are consequences, including but not limited to an increase in the interest rate charged, or even mandatory immediate repayment of the loan. Increase in the interest rate charge will basically cause the cost of borrowed funds going up, right? So this will typically affect the company's profitability in future. An immediate repayment of the loan can potentially create a bankruptcy risk if the company is not able to get refinancing, right? So there are pretty severe consequences. So to ensure that the borrower is not manipulating financial ratios, what do you think is typically required? So how do the lenders believe the numbers that the borrowers are providing? Absolutely, Benjamin says audited financial statements. Lenders require audited financial. Then depending on the size of the company, usually from the larger audit firms, because there's an additional layer of credibility attached there. Okay, so this was what we had talked about in our class last time. We said managers, they do have an advantage over the lenders as well as the shareholders. So they can sometimes abuse their informational advantage to manage reported earnings. So even though lenders will often require that the financial statements must be audited, there is still a possibility that managers can abuse their information advantage, resulting in earnings management. So first of all, how do managers have an information advantage? Well, before they sign the employment contract, managers would have an idea about what they can achieve, right? And whether they're likely going to be working hard or whether they'll be shirking. We saw in the example of Yvonne, Yvonne was able to kind of get a sense of whether she'll be able to achieve her reservation utility, and if so, then would it be better for her to work hard or would it be better for her to shirk? And so managers kind of have an idea about what, you know, so when there's negotiations going on about, oh yeah, there's going to be certain amount of base pay, there's going to be certain amount of bonuses involved, and so on. Managers tend to have a fair idea about what they are likely going to be able to deliver and whether they would want to work hard or not. But even after they've signed the contract, managers can, because they have access to information sooner than the shareholders or the lenders will ever get, managers can act before uh, you know uh, they are committed to the act. So they might accept the employment contract, but if they go in and believe, oh my God, this situation is terrible, it doesn't look like working hard is going to pay off for me, or doesn't make sense for me to stay, they could resign, right? So they could resign from their position if the situation is terrible. But they also have the opportunity to choose amongst accounting policies. And we've talked about that when we talked about economic consequences. So managers are able to choose accounting policies that can have an impact on the reported net income. And that's what's called earnings management, that managers can affect reported net income. If you have a single period contract, the rational manager will try to maximize net income as much as possible, because if they are to receive a bonus based on reported net income, they will try to maximize their income as much as possible. And it doesn't take a lot of imagination to come up with ways in which managers can do that. They can see if they are able to use accruals to affect the reported net income, but they can also take certain actions that are called real earnings management, cut back on scheduled maintenance, cut back on research and development costs, because that can boost reported net income. Now, the question might be, why do managers resort to earnings management? Um, Keep in mind that for Yvonne, even if she worked hard, there was no guarantee that net income will be high. Yes, there's a strong correlation between hard work and high net income, but there's still a small chance that even after working hard, net income might not turn out to be as high. So there is a compensation risk involved, right? That was part of the reason why Yvonne was a little hesitant when she was offered a revised contract. And compensation risk has an impact on the expected utility of compensation for a manager, right? So if for whatever reason, in spite of their hard work, managers are not able to achieve a high net income, then they will try to embellish the reported numbers through earnings management. Now, is there a way for us to limit managers' propensity to manage earnings? It is possible. Um, and there is a concept of revelation principle. So guarantee that managers will receive the same amount of pay whether they report biased numbers or not, right? So it is in theory possible for us to design contracts that managers will not feel compelled to massage numbers. And there are circumstances when you can limit the available accounting policies. So GAAP can impose certain limitations in the form of limited accounting policy choices, but we can never eliminate that because some amount of accounting policy choice is needed, right? So there can be certain actions taken by the accounting standard setters to require uh, certain consistency in application of accounting reporting standards so that there is less possibility of earnings management happening. And one such device is that if a company ever voluntarily changes its accounting policies, they have to restate prior period numbers. So it imposes a cost, right? It imposes a cost upon the company, and you know, it becomes very clear what the impact of the new accounting policy would have been on prior periods' incomes as well. So people will be able to still make an informed decision when it comes to either investing in the company or lending to it. There is an argument made that individual and social norms can have an impact on people's behavior. So that it could just be if a person is deeply religious and they believe in the afterlife, etc., and they believe that earnings management is inherently bad, that person might not, you know, seek to manage reported earnings. So that is agency theory with psychological norms. There has been work done on that field, that there are people, belonging to or having certain psychological characteristics who will not resort to earnings management. In fact, if you've heard of Max Weber, he was a German sociologist. He came up with his book on the iron cage of uh, his illusion was that the Protestant work ethic. So folks belonging to the Protestant um, sect of Christianity, uh, they believe that if they ever did a bad deed, they will suffer forever, right? They will suffer in eternal hell, damnation, etc. And that imposes this expectation on them that they will work hard because working hard is the only path to salvation. So if somebody kind of believes in that, then they will work hard without having to lie, right? Because lying is bad, etc. Now, I don't want to get into controversy on that point because then the implication is that if someone's not, a Protestant, that they are more likely to lie. Um, I don't want to. I don't think that's the implication here. It's just that people, due to their own personal beliefs, may sometimes work hard. I know many employees, many people who work hard regardless of pay, right? Even if they are not very highly paid, even if they are never paid, even if they never receive a bonus, etc. They just, it's in their work ethos, right? They do come to work and they put in 100% every day in, day out, right? So there are those people, but then there are also other people who don't want to work hard in spite of how much they are paid, right? So you can have different outcomes depending on the intersection between a person's beliefs and the opportunity, I would say, to manage earnings. Because sometimes all it takes is the opportunity, right? I am as honest as I can be until the opportunity arrives, right? Then who knows? So you can have all possible scenarios due to the interplay between personal and social norms, right? Social norms are how managers, how others perceive you, like how you feel others will see you and how much you care about that, versus the individual psychological norms are your own personal beliefs. We've already dealt with how lenders can protect themselves from adverse effects. So what are some of the adverse effects if you want? It's possible that managers can um, engage in actions such as paying very high amounts of dividends, continue to borrow additional amount of money, thereby diluting the amount of security that the lenders have, or borrowing money to invest in very highly risky projects. So you're essentially gambling with other people's money. If the risk pays off, the company makes a ton of money. If it doesn't, you declare bankruptcy. Certainly, in those cases, the lender's well-being is compromised. So, in order to protect lenders, number one, lenders should anticipate such opportunistic behavior, and we saw that in Mr. K's requirement that there should be a debt covenant that limits the amount of borrowing if the times interest earned ratio is breached. So you impose these restrictions, increase interest rates, have some consequences if the covenants are not followed. Or another possibility could be that lenders could require managers to lend money to the company. So have a personal skin in the game in the overall affair. So if the manager becomes a lender, just like in the case of shareholders, the idea was give the manager a share of the profits or make them shareholders in the company, because then they would have something of their own at risk. This is imposing risk on the manager in the form of requiring them to lend money to the business. So that is another possible route. It can have negative consequences in the sense that if someone is very, very, very conscious of the level of risk, then managers could become too risk averse. And you don't want that to happen as well, because that can then result in managers just becoming bureaucrats, right? One of the things that CEOs and CFOs are supposed to do is to find out new profitable projects for the company to invest in. If, on the other hand, they become too conscious because they have a lot of money invested in the business, then they might shy away from taking those risks. And that is not, in the long run, in the best interest of the shareholders or even the lenders. Does agency theory have any implications for accountants? For sure, because we know that as accountants, we have to help the business navigate through a bunch of contracts that they have, be they with suppliers or employees or lenders. And so oftentimes we as accountants have to make sure that the company stays within the within the lines of the parameters of those contracts. Um, our reported numbers are often used. The numbers that accountants prepare are often used as inputs in such contracts. So a bonus contract might specify a rate of bonus based on reported net income. All right. Debt covenants can be based on liquidity or debt to equity ratios. So accounting numbers are often put into use to determine those contracts. And of course, if we study these contracts, we can better understand why management is often very interested in reporting certain numbers. Why, even though there are no cash flow effects, accounting policy choices can have economic consequences. So there has been research done on this field. Holmstrom, in a 1979 paper, came up with some research that talked about how a contract that is based on a performance measure like net income is less efficient than a first best contract. So what he argued is it is better to have two performance measures. So rather than basing an employment contract on a single net income type uh, target, base the performance contract on two instead of one performance measures. So share price might be another good measure. And what you're doing here is you're managing the time horizon of the managers. Because net income is a short-term oriented measure, and share price tends to be more forward-looking in terms of longer run impact of managers' actions. If a company uses two performance measures than one, we are able to get a better mix of effort and risk taking. And when we are using two performance measures, both of them should be incorporated in the compensation package. We can decide upon the weighting depending on what our intentions are. If we want managers to work hard on short-term performance, increase the weighting of net income. If we want managers to focus more on longer-term share price growth, then we can increase the weighting for that. In deciding which performance measure works better, we have to consider two attributes of a performance measure. One is the sensitivity, and the other is the precision. So sensitivity is essentially the responsiveness of that particular performance measure to effort. So think about, if you consider a scale, right, a weigh scale. If you think about a kitchen scale and you put an apple on top of it, the needle will move quite a bit because given the amount of weight that that kitchen scale can handle, the apple is considerably heavy. Now, if you happen to put the same apple on, let's say, a weigh scale intended for a person's weight, right, like a bathroom scale, you put an apple on top of the scale might not even register that something has been placed. The sensitivity is by how much does the performance measure change in response to the manager's effort, right? If the manager's been working hard, do we see a reflection of that effort in the performance measure? So one can argue that stock price would likely respond to the actions that management takes towards improving the financial prospects of the company. And stock price responds to uh, other sources of information as well, right? So if there are other sources of information, such as actions taken by competitors, that would get incorporated in stock price as well. If there's changes in other macroeconomic factors, the share price will respond as well, right? So you have share price that is very sensitive. And then you want something that is precise as well. And that tends to be the job of net income, because precision is about reducing the sense of risk that the manager has to bear, right? So precision can reduce the anxiety that a manager might feel about being able to achieve his or her targets, right? So net income, because net income typically tends not to vary as much, right? Net income is a consequence of revenues minus expenses. And yes, managers are able to adopt certain accounting policy choices, etc., but they cannot make huge swings in net income, right? That's just not possible. Huge swings are just not feasible. They can't work in a business that is well established. So net income tends to have greater precision. So it's low in sensitivity, as I mentioned. Net income is low in sensitivity, but it generally tends to be higher in precision than stock price, because stock price changes all the time. So we use net income in conjunction with stock price. Net income tends to be used for measuring short-term performance, and stock price tends to be used for longer-term performance. And the challenge for us is to try to keep improving net income sensitivity, right? If we can somehow make the net income number more sensitive. And part of the reason why we have been moving towards incorporating more fair value information is to make net income more sensitive to effort, right? So fair value information, the more changes in fair value that we include in net income, the greater will be the reflection of net income as an indicator of managerial effort. Stock price tends to be very, very, very sensitive. It's also very difficult for a manager to impact as opposed to net income. So just for that reason, that stock price is an objective measure, it's definitely recommended along with a net income or an operating income type target. It's also, as I said, more sensitive to managerial effort, but share price tends to be very volatile, right? So it's less precise. So it tends to be fairly noisy. Inevitably, when businesses want managers to apply their efforts to the company's well-being, um, we can't choose to use net income only, right? If net income is a biased predictor of future payoff cash flows, then we are trading off between sensitivity and precision. So we need to add a secondary measure such as share price. Otherwise, it becomes a problem. So the example here is talking about reserve recognition accounting that we talked about way back. That was the oil and gas companies. It provides useful information to investors because its relevance is high, even though its reliability is low. But using RRA in compensation contracts is not advisable because it lacks precision, and the lack of precision will outweigh its sensitivity, right? So you want a certain amount of precision as well, whether I've met the target or not. If there's going to be uncertainty about whether targets have indeed been met or not, then it can lead to litigation. It will not serve for efficient contracts. So typically how it works is you have managers that are offered a base salary, and we've already seen the examples of it. Managers should be paid a base salary, and then they should be paid a bonus, usually linked to the what we call it, the net income, right? The next year's net income. And then there's a portion that is linked to longer term stock performance, and that can be in the form of stock options or stock awards. So usually you'll have three components of compensation contracts. When we do the chapter on compensation contracts, we will revisit this piece, but that is in response to Holmstrom's work on compensation. Lastly, we are going to try to reconcile efficient market theory with economic consequence. Remember, contracts are rigid. We cannot anticipate everything that can happen in the future, right? So contracts are incomplete as a consequence. But once they are signed, they become rigid because they have to be they can be enforced in a court of law. So, you know, if you have debt covenants raised, debt covenants that a company agrees to, and you have something like COVID hitting, if lenders had insisted on those covenants to be met, then a lot of businesses would have gone bankrupt, right? So sometimes you need a way out. So accounting policies that a company uses, if they have an impact potentially on debt covenants, they can also result in economic consequences. And we've mentioned that. We've learned about economic consequences that, if my interest rate goes up in the future, my interest costs are going to go up. And it's also going to have an impact on my weighted average cost of capital, which is the input, one of the inputs that I use in determining net present value of future projects. And if my net present value on future projects goes down, as a company, I might not be able to invest in a lot of profitable future projects, which will then reduce the overall financial success of the company in the future. And that's going to have a negative impact on stock prices, right? So overall, just by failing to meet a simple debt covenant now, I could be putting a company well on the path of financial ruination, or certainly a lot of decline, just because the debt covenant violation triggered an increase in interest rates. All right. So we're not talking about markets, securities markets not being efficient. It's just that you have these series of domino effects that can be triggered by a sudden breach in a contract. So that is the reason why we allow for managers to have some choices. Since at the time of signing the contract, we cannot foresee all possible contingencies, but contracts once signed tend to be rigid and binding, we have managers remain concerned about the inflexibility that is imposed by rigid contract. That is the reason why managers will often try to influence, try to interfere with not only the accounting policies that the company chooses, but when new standards are being established, they also try to influence the standard setting process. We'll be seeing that in the standard setting chapters as well, that companies often will interfere in the standard setting process because there are economic consequences arising from those standards, even if cash flows don't get affected. That, my friends, concludes our discussion from last week. So we had not finished chapter 9 last week. We are just about finishing that tonight. Here's some suggested questions from the textbook. Now, it is 7:40, and I believe we've been going on continuously. You've been listening to Harjinder. There's only so much of Harjinder that you can listen to. Should we go for a bit of a breather, like a 10-minute break? Okay, let's do that. Let's go for a 10-minute breather. I I will I will prepare the answer and post it, right? I'm not for the Arnold and Mini question that we started working on. It asked what percentage of net income did Arnold offer and so on. So there's a little bit of algebra needed for it. I will complete the answer and post it, right? So what I intend on doing is once we come back, we should move on to the next chapter. And I am aware of the quiz. I still have not completed. As usual, I've not yet completed on time. I'm sure some of you are not happy, but I would rather be right in my marking than mark it in a rush, in a hurry. So I expect I will get that done in a latest by a couple of days. So by Wednesday, you should have the marks in. Um, I know that some of you might have some questions to ask about the term paper, etc. So I want to keep some time about that as well. So when we come back, maybe I'll field any questions that people have about the term paper. And once that is answered and taken care of, then we will move on to the next chapter. Okay. So it's about 7:42 now. Let's just round it to 7:55. Let's be back by 7:55, and then we'll see how long we can proceed from here. Okay. So any questions about the term paper requirements? And I know I've heard back from I did not check the email messages after um, the morning today, so there may be additional emails, but I think in the morning I've gotten an email from one of the groups. They want to do their work on efficient market efficient market hypothesis, and so they want to question that hypothesis in light of the learnings from behavioral finance. So they've sent me two articles. So I've not had a chance to take a look at the two articles. I'll get back to them. If there's anybody else, like any other group, has some ideas, I'll be happy to um, provide a quick response if there's any needed. Looks like we're all well set. No questions immediately. Okay, in which case then let's move on to executive compensation. So this particular topic is shorter compared to what we've just made our way through. So I have less to talk about here. And it's a carry forward from our discussion on agency theory as how it applies to